Okay, so let's go through where we were. Okay, 2019, 2020, the next slide, Jill. We had low interest rates and low inflation. Okay, so that was 2019, happy days, and then down the mine shaft and a quick recovery pivot. Equity markets, growth, income opportunities. It was go, go, go. We were having lots of order calls. Most sectors would shine in this space. Even if you're a defensive stock, even if you're a boring bank, okay, you will still do well. Okay, although a bank is known as a defensive stock. I'm not talking about military defense. I'm talking about what is defensive in terms of its nature. Banks are seen, pharma, even FMCG, fast-moving consumer. You still got to buy food, but you're buying food even times are bad. You might just be buying the store brand as opposed to Hellman's mayonnaise now. But there's a lot of discretionary spending. So you're splurging out the mozza out the wallet. You're buying your luxury consumables, leisure, travel. You saw the picture of the jets and the big cars. It's doing very well, and people are tapping e-commerce. Clicking on instead of going into the bricks and mortar. There are more clicks than bricks. So all those themes there, we were using during these type of cycles. So you've seen a lot of e-commerce. You've seen certainly automobiles. You've seen leisure travel. It's all there. So two of the obvious ones, your sort of Amazons, your Teslas, and to a degree we have we've sided with big companies. Big is better, but there have been many occasions where we've gone for smaller companies. Banks. Okay, so this is what's quite interesting. When you style a growth stock in this type of environment, banks are eager to get hold of your money because cash is going into equities. Cash is going everywhere. You're buying cars, you're buying stuff that the bank doesn't. You're buying it cash as opposed to them financing it. So they're trying to bring cash onto their balance sheet. So their cost of capital, they're quite happy to raise it. So they'll give you a 15 or 16% coupon quite happily because they need cash to keep going. They need liquidity ratios. They need bank adequacy ratios in terms of governance and risk and compliance. They've got to keep attracting cash. So they'll pay you high to attract that loot. So during those heady days, you can certainly structure high returns, high payoffs in growth and conditional income. So we're very active in the space, and banks get very active as well at the same time. If you remember, low interest rate for a bank, so they got lots of money, but they're not making much on the margin. Okay, so they can't attract more money. They basically sit there with quite a low net interest margin. That's very, very different in the current scenario, and we'll have a look at that now. If we can go to the next slide, Jill. So this is the middle guy, high inflation. Okay, this is sort of your 21, 22 into 23, how it started rising. Inflation popped its head out. So some defensive stocks are going to start. So your commercial investment banks, they'll say, right, we'll lend you the money, but you're going to pay more for your debt. Okay, can you service it? Let's do this. You've got to give us more money. You've got to give us more collateral. So banks balance sheets get much more bloated. Okay, with high inflation and rising interest rates, you're not paying more for your car, more for your luxury boat that you bought in the previous year. You're paying more debt on credit cards, and cost of living, input costs are going up. Everybody from the farmer to the shop floor to the restaurant is feeling it, and prices have to go up. And the consumer servicing his debt, so he puts the mots back in the wallet. And obviously, from a stock selection perspective, if you're an analyst, if you're a quantitative analyst, you start looking at what companies are carrying debt. Can they service that debt? Have they got cash for another 90 days, 12 months, 3 years? Where are they getting their cash from? Is that cash going to dry up? And if you're carrying a lot of debt, how are you going to service that? Well, there's different ways of doing that. We won't get into tonight, from rights options to new issuances of stock. But basically, I look at debt very, very carefully. There's good debt and bad debt, but bad debt on a company's books is something you say, this is something it's a bit of a flag we need to look at and interrogate more deeply. And your debt to equity ratio has become quite important now, because if your debt overtakes what you're worth, you go out of business. And we don't want it happening in any of our baskets. Thank you very much. So there's more stress coming through here. And your discretionary spending starts taking pain. So during this period, we started putting together the hybrids, and also more strongly the guaranteed coupon type notes, where, okay, irrespective of what's happening, there's the theme, it's been underwritten, and you're going to get your 12%, your 3% per quarter. Okay. And then moving on to the current sort of situation is this higher interest for a longer period of time. I've mentioned that the fact that rates aren't disappearing overnight, that they're not in a hurry to let down the handbrake, which means that some sectors, so it's kind of more of the same, and who's going to benefit, and why haven't the banks been playing ball with us? So, we can keep the picture of a fat cat in the background with his big Cuban cigar. Some sectors will continue enjoying these better margins. So, but they're starting to carry risk now. So you take a bank as an example. Banks are they've got their mortgages, rates have gone up, people are paying higher amounts for their lending obligations. But if rates stay too high for too long, those people might just give up the ghost and say, you know what, here's my house back, here's my car back. And then banks have impairments. They've got to carry bad debt. They've got to carry provisions for that debt, writing off debt to their shareholders, to their profits, and ultimately to their earnings and ultimately to their profits. So they can, if this goes on too long for the banks, the fat cat could end up getting a bit scalded. He could, like he's on a hot tin roof. So, but at the moment, they're doing very well. And because of that, because they don't have this high cost of capital per the previous low interest rate situation, inflation situation, they can afford to be a little lazy and say, look, we don't have to go out and hunt lots of money. It's coming to us almost by default, because there is a little bit of return in cash now. So hang on, the money's coming to us anyway. Why should we talk to Cashbox and offer them 14%? Because we're getting the loot in anyway. But let's offer to them at 6%. But we know the margins that they're making, that there's a bigger margin they're keeping for itself. They're skewing it to the bank, which I think it's greedy. So we're not prepared to play that game. Sure. I mean, Graham, I don't know if you're on the call, but I mean, there's lots of 6 and 8% coupons going around. We're going to wait for the right moment in the right sector and the right timing position to put the right product back into our community. So interest rate, the second point is absolutely on point. That interest rate sensitive sectors are taking strain at the moment. We saw it through 23. So there you go, e-commerce. People aren't clicking as much now because how long is this going to last for? Maybe I should leave some money, not buy the set of golf clubs, not buy the condo. Let me just pay my rent, pay my debt, and keep myself solvent. So discretionary spending has taken a bit of a hit. Non-discretionary sectors are enjoying the spotlight. Okay, so what I mean by non-discretionary sectors are companies in sectors where you still got to carry on buying stuff. You still got to go and buy toilet rolls and food and fuel and rent and all those mandatory things that keep us going and a roof over our head. So that's non-discretionary, especially in things like consumer staples. You still got to eat. You might switch from, as I mentioned earlier, from your premium brand of whiskey, and you might buy a store brand of whiskey or mayonnaise or whatever it might be, tomato sauce. So there's also, you got to be careful there. It's not just like, let's all rush off and buy Unilever and Kraft Heinz foods, because there's a big shift. We've seen it in terms of the big American superstores, how people are buying store names now. So maybe it's better to go with Target or Walmart as opposed to going with Kraft Heinz or Nestle. So there's subtleties. But we have been looking at that. And I come back to this, what is this rate cut thing? And everybody's talking about, when rates go down, it's going to be good news. Well, the bottom line, it is going to be good news. There's no getting away from it. The question is, when's it going to happen and to what degree and severity? So I mentioned that many pundits were saying there are going to be 6 cuts in 2024, starting in March. Then they toned things down a bit after the first meeting. And they said, these might come along only in sort of June. And as of last week, that was scuppered. And I think there's a 23%. So the Federal Reserve is made up of 11 managers, 11 Federal Reserve governors. And 2.5%, I don't know how they get to 2.5%, but 2.5 of them, they are saying that, rates are definitely going to get cut in September. That's the next meeting. So this is quite a long window. So higher for longer seems to be the mantra. The one thing that I find incredibly interesting about stock markets is that on a small piece of bad news, a whole sector or a whole environment can go into a complete free fall. and the next day it free falls back up again. So if you are going in and out the market as a trader, it's very difficult. Like number 10108 finds out, he looks over his shoulder, he doesn't know what's going on, because sometimes it hits you and you're not quite sure. Structured notes are different asset class in terms of some of the thinking's being taken out of it for you, in terms of it's a contract, it's presented, it's T's and C's, you know what you're getting, you know what you've given up, and you know what you can expect, okay? And it is relative depending on which note, in terms of what point of the economic cycle was it launched. Is it growth? Is it conditional? Is it guaranteed? I've got clients who are in guaranteed and they're as happy as Larry because they know it's coming along every 3 months. The banks aren't writing those at the moment because they're saying, well, we don't need to. We can just get cash in. It costs us nothing. So it's not just the banks. You know, it's I play on them, but all those other forces that are currently with us at the moment, there's a lot of headwinds and appetite that sometimes is suppressed, sometimes that it's very greedy. But I think one of the points that we've tried to make tonight is that this is quite a complicated world, putting together an investment with a basket, timing in terms of when do you launch it, how long will it last, will it survive into different themes and different eras of an economic cycle. You know, it's fairly fixed in terms of if it doesn't auto call, you have to hold it to term unless you obviously break it, and then there's a slap on the hand, a punishment, as opposed to like, well, I'm going to go and buy a Tesla and I'm just going to hold it forever, and if it works, it works, and if it doesn't. And structured notes are different. They're more risk off. You're giving up a lot because Tesla might go through the roof again, or it might go through the floor. In our instance, we've got deep levels of capital protection. We've never strayed from that. We've always, as part of our DNA, have said we want deep levels, the best levels of capital protection. We want the best issuers. We want the best structuring partners that we can get. We want open dialogue and front up to our community if things aren't working, and what can we do to maybe influence something along the T's and C's. I think we've become a very interactive group of people in terms of our community, not just us going out. Community come back to us with all sorts of ideas and issues and questions, which is great. I know Chad and the team are doing lots of reviews at the moment on the experiential side, and I think the lessons we've learned and are putting in place now are very, very important, because if Jill takes, and Jill's going to start now, she's going to take you through the protection levels. So when you're in growth phase, it's easy. It is actually quite easy to structure. The banks are greedy and they want your money, and they'll give you a great coupon. The moment it's harder, but as those turbulent times we've gone through, we've started introducing, as I mentioned earlier, these attributes, these protective attributes, and all of them are there to skew it in favor of us, not the bank. Okay, the bank would like to hold your money as long as it can, but for us to, at a point in time, to either exit the position and then reassess, can we go again? Should we do something else? Should we reinvest? But also the features to unlock that money. You don't see a lot of these features in the retail market. This is institutional stuff. Chad always says, that we are bridging the gap. That's on our sort of logos, bridges, our sort of connective image is linking the corporate institutional type of return space back to a retail investor who's got, let's say, for example, $10,000. These type of features you see in ultra high net worth notes and high net worth offices. So we're very proud of the fact that we've had a good relationship and a fantastic relationship with our structure and the banks for them to introduce these, because we certainly feel we're adding more belts and braces, great English expression, in a complicated world, and the world seems to be getting more complicated. We are trying to take out that complication for you to say, these are your protections, this is what we're seeking to achieve, these are the outcomes. And then for you to do, your particular homework on the particular note if it fits into your investment style and strategy and requirements. So I think that's a great quote. I'm not sure, proverb. You're never too late. I think that's the bottom line. So I'm going to, I think, swing it back to Jill at this stage in terms of the standard and enhanced features that we've been bringing to the notes over the last couple of years. Thank you for listening to me.